Hi, welcome back to the continuing lecture in Principles of Finance. This is Dr. Jeff Holm, and we are continuing with the risk and return that we discussed, in the last class. And in our last class, we calculated basically expected return and the variance and standard deviation with the data downloaded for Apple. Now, so if you remember the data that we downloaded, right? And of course, we downloaded monthly data, but specifically, if you looked at the daily data, daily price data, you would see daily price data is almost like a random occurrence, right? I mean, in the long run, there is a deterministic trend in the long run, and over the past 5 years, and certainly over the last 40 years, Apple has been consistently growing, right? So there is a positive trend, which is a deterministic trend, right? Positive deterministic trend. But looking at the daily data from day to day, also intraday, if you look at the intraday data, by every minute, by every 5 minutes, or by every minute, the fluctuation is so random, right? Of course, within the day, the price action is a movement between, the high of the day and the low of the day, but that movement by itself is very random, right? And then just because today price was, today's price was higher than yesterday's price, it doesn't guarantee that tomorrow's price would be higher than today. Also, even monthly price, generally, if there's an in the long run, I mean, we got Apple's mean return, right? And Apple's mean return was almost like 1.81% or something like that, which means on average, Apple is growing at monthly at average a growth rate of about 1.81%, right? So clearly, on average, there's a positive growth monthly, but in reality, actually, month to month, it could be negative, right? So 1 month it was positive return, but the next month it can easily be a negative return, right? So in other words, individual data actual individual data points are basically random variables, right? Random variables. That's why we needed to, we wanted to find the mean of this random variable, which is, mean of the return, right? And then standard deviation of the return. So we talked about this, mean is the expected value, right? And this is a notation you should recognize. What is this? This means X bar. If the mean of X, right? X is a random variable, like, the numbers on the a dice, right? When you roll a dice, I use this example. Any number randomly, any random number can come up between 1 and 6, right? So this bar means mean, average, right? And then a sum of all the individual numbers, right? Uh, times the probability of the number coming up, right? So xi, where xi is the number. So in the whiteboard, I basically wrote this. It's the same idea. So I runs from 1 through n, right? But again, if you think about it, um, the in this case, n runs only to up to 6, right? 1 through 6, and probability of so if I is 1, x would be $1. If I is 2, x would be $2, and so on, right? Now, probability of each number coming up, right? Each I, probability of xi, is all the same, 1 over 6. So I told you, in case of this dice game, because dice is a fair cube and the probabilities are all the same, so eventually although we represent it with the probability, but since the probability is all 1 over 6, you factor out the common factor, and then it simply becomes the simple average, right? So I told you when probabilities are all the same, uh, uh, the average of all those possible events, or average of those possible events, is the simple average, and simple average is a special case weighted average where all the probabilities are one. I mean the same. Sorry, 1 over 6 in this case. All the probabilities are the same, right? 1 over 6 in this case. And of course, the sum of all the probabilities must be 1, right? If you sum all the probabilities, it must be equal to 1. So this is why you can express the mean. And so, of course, probability probabilities are probabilities can be described by a histogram like this. And it's called, and the possible events are discrete. Discrete. For example, if you're rolling a dice just once, the possible occurrences are 1, 2, 3, 4, 5, and 6. So we will have probabilities, and it's called uniform probability distribution, uniform distribution, because each number has the same probability. But this is an example of probabilities of flipping a coin. Now, if you flip the coin 4 times, right? If you flip the coin 4 times, first of all, there are 2 probabilities, 50-50 of either head or tail, right? And then there can be 4 possible, and if you flip it 4 times, right? 4 flips, right? Then there could be I mean, if you flip it 2 times first, let's think about 2 flips, there can be head, right? There can be head, tail, right? Or there can be tail, right? And there can be tail and head, right? So that's a example of 2 flips. If you do 4 flips, the probabilities will be and there will be a 2 to the 4th. 2 to the 4th is 16, right? 16 possible outcomes, right? So head, 4 straight heads, right? Or head, 3 heads and 1 tail, two heads and two tails, one head and three tails, right? And then four tails and zero head. I mean, that will be 16. But actually, these are actually, although it says four flips, but it looks more like two flips, right? Two flips, because then there will be uh, uh, four heads, zero heads, right? Uh, uh, and this is one head, three tails, two heads, two tails, and so on. But if you do these experiments, you will see the distribution would look pretty much like this. But still, if you connect those top of those histograms, it would look like a normal distribution curve. But it's not a curve just yet, because the possible events are still discrete, right? If the possible events are continuous, right, then it will be a perfect, uh, curve. And by continuous, I mean, what would how would you get a continuous distribution? You remember Euler's number, right? If we use Euler's number, in other words, exponential function, then it can emulate the continuous distribution. But anyway, so that was discrete distribution, but this is continuous distribution. And this distribution curve is called normal distribution curve, and this looks like a distribution of height, right? 5'8" being the mean, and 6'6". This is not the end of the tail. This looks more like two standard deviation from the mean. 4'10", also two standard deviation below the mean. Now, so 5'8", 6'6". There's almost about 6 inches and 10 inches difference, right? 5'8", so 12 inches. 5'12" is 6, right? So 4 inches more, right? There's 4 inches to 6 feet and 6 more inches. So 10 inches is two standard deviations. So it looks like 5 inches is one standard deviation. So what does this mean? So if you roughly, if you if one standard deviation is 5 inches, right? People who are so 5 inches above this is like 6'1", right? So one standard deviation above mean is 6'1". Two standard deviations above mean is 6'6", and one standard deviation below mean is 5'3", and then two standard deviations below mean is 5'10". So this would require some, understanding of normal distribution properties. Now, a lot of things in nature are normally distributed. Height is one good example. Okay, so suppose we have, let's see if I can use, yeah. So if 5'5", that's not 5. That looks like 6. Oh, it has to be one line. If 5'5" is the mean, right? Maybe I can use the pen. Oh no, that's signature now. Okay. So this was like 6'1", and this was like 5'3", 5'8" is the mean, right? So within one standard deviations, right? There are 68%. There is a 68% probability. There's 68% probability that out of 100, right? If we have, why is it so, if we have like 100 observations, in other words, if we measure the heights of people, and if we randomly pick 100 people, and if we measure the height, and if the average height is 5'8", about 68%. The better way of correct way of saying that is the probability of anyone randomly picked is the probability of anyone randomly picked falls between 6'1" and 5'3", right? Is 68%. You understand? So out of 100 people, right? I mean, so we have the average height is 5'8". So you just randomly pick 100 people passing by, and if you pick one person, and the probability of that person falling into this range of 5'3" and 6'1" is 68%, right? So the probability of falling within one standard deviation around the mean is 68%. That's what it means. And then that means the probability of falling within falling between the mean and one standard deviation above mean is half of that, 34%. And the probability of falling between mean and one standard deviation below the mean is another 34%. So the sum of those two is 68%. So if you are like 5'11", right, you are one of those people who fall into this 34% probability, right? If you are 5'5", you're also in this 34% probability, right? Now, and then there is, okay. Then the probability of falling within two standard deviations around the mean, right? Two standard deviations around the mean, right? This is two standard deviations, right? Is 96%, right? The probability is 96%. 96%, right? So if you pick anybody, out of 100, right? It doesn't have to be 100, but just to make it simple. I mean, if this is if this height statistics is from a large population, right? From a very large population. Let's say you measure everyone's height data of everyone in the U.S. That's almost 300 million people, um, and the average height. And of course, you will have to measure the height of the grown-ups, right? Grown-ups. Um, Obviously, but a 2-year-old baby or 1-year-old baby will not. I mean, if we include still, even if you include entire population, I mean, if this 5'8" is the average of the entire population, it will still hold, right? Um, but anyway, the idea is 96% of the population, right? The population here in this context doesn't mean the population of people. When we say population, it means entire data set. Okay, entire data set. So in other words, if you measure the heights of everyone in the U.S., in other words, 300 million people, right? That's the population. But you cannot do that. I mean, realistically, that is, impractical, right? You have to track everyone down and measure the height. That's impossible. I mean, it may not be impossible, but too time consuming and impractical. So you just use a sample group. So you pick like 1,000 people in within 5 boroughs of New York City. Okay, those 1,000 people is a smaller sample than the entire population, right? That sample group is and that sample group provides a limited data set, but that if that data set, that small sample group is randomly picked, right? Then that random sample uh, 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 random sample can represent the entire population. But once again, if you just pick the random sample from New York, 5 boroughs, greater New York area, that cannot be a real sample for the entire U.S. I mean, to pick, 1,000 a random sample of 1,000 people, then you have to go around the entire 50 states and then pick, randomly 1,000 people out of 50 states, right? And in equal proportion, right? So to make 1,000 people from 50 states, and from each state, just 20 people, right? Randomly picked. Again, so that's the distinction between population and sample, right? Population is the entire data set. Sample is a local data set, limited data set. Okay, makes sense. So let's say, so this notation, you see this notation mu, that's Greek character mu, right? What does that mean? That Greek character mu, that's for Roman alphabet M. So that means mean, right? The average, right? And this is Greek character sigma. And of course, sigma is S. That means, that stands for standard deviation. So basically, if you pick, I mean, if this is, let's say even, sample data from, 5 a greater New York area, right? 5 boroughs plus, surrounding counties. And the average height is 5'8", right? One standard deviation is 5 inches, right? And 2 standard deviation, 10 inches, right? And so on. So that means if you randomly pick anybody, right? Just if you go down to the 42nd Street, Broadway and 42nd, randomly pick anybody, the probability of that person falling uh, within one standard deviation around the mean, right, is 68%. And the probability of that person falling within two standard deviations around the mean, which means, so this would be 5'2", this would be 6'6", right? So uh, the probability of a random person falling, and that's a quite broad range, 5'2" through 6'6". That's a very broad range. Uh, that have wouldn't that have a high probability, 96%, right? Anybody pick randomly, right, falling in the height range, that's very high, 96%, right? That means uh, the probability of that person falling between 6'1" and 6'6", right, is 14%. Right? It says 13.6, but roughly, that's rounded. Why? Look, this is 96%, right? Two standard deviation is 96%. The probability of falling within one standard deviation around the mean is 68%. The difference is 28%. Isn't that right? So half of that, 14%, falls here. The other 14% falls here. Makes sense? Okay. So if two standard the probability of falling within two standard deviations around the mean 96%, then the rest of it will be 4%. Makes sense? The rest of it will be 4%. Out of those 4%, 2% will fall here in the upper tail area, and 2% will fall here in the lower tail area. So that 2% means what? I mean, think about it. That's a very rare, low probability, isn't it right? Either way, right? Um, so what is the probability of randomly running into a person who is taller than 6'6"? I mean, if you walk down the street and just randomly run 100 people, what is the probability of running into someone taller than 6'6"? Exactly, that's less than 2%, isn't it right? And also, if you just walk down the street and run into 100 people, what is the probability of running into more than 5'2"? That is also like 2%, right? So both tails, up tail, lower tail, right, up tail, or right or left tail, these tail areas are called outliers, right? Outlier means, literally lying outside the normal distribution, 96% range, right? Extreme, uh, extremely high, extremely low. They both have low probabilities, extremely low probabilities, but the upper tail, lower tail end, right? Upper tail end, lower tail end. Okay, so that's why it's called outlier. They are lying outside. Now, then how does that? What does it have to do with Apple's return? Now, think about it. So Apple's mean was like 1.81%. Let's just say 2%, right? 2% for simplicity's sake. And Apple's standard deviation was what? It was about 7%. right? It was greater than 7%. For simplicity's sake, let's call it 7%. So if the one standard deviation is 7%, right? One standard deviation above mean is 9%. Two standard deviations above mean will be this plus 7, so like 16%, right? This point will be 16%, this point will be 9%, right? And then one standard deviation below mean will be negative 5%. Negative 5. And then two standard deviations below mean will be negative 12%. Right? So this gives us a better idea about what our chances, what is our probability of earning our target return. For example, Apple's mean return is about 2%, right? Monthly, right? That means you have 34% probability of earning anywhere between 2 and 9%. And you also have 14% probability of earning anywhere between 9 and 16%, right? Remember the best month was like August of 2018, right? And if you go back to the data, you will see. And at the time, they earned like 19 point something percent. So that was 19 point something is really, really this upper tail outlier. That was an event that has only about 2% probability of happening. But that happened in August of 2018. Also, it also means you have 34% probability of earning anywhere between 2 and negative 5% return, right? Next month, right? And also, that means you have 14% probability of earning anywhere between negative 5 to negative 12% return. And you also have 2% probability of earning anywhere below negative 12% return, right? And also, you remember the worst month for Apple was November 2018, and they had like negative 18% return in November. So that lower tail 2% event happened in November 2018. Outliers can happen, but with 2% probability. Make sense? Now, so with that, okay, let me go back there. I guess this is causing a lot of, flickering. So let me delete this because it's causing. All righty, so then going back to, so this is, basically what variance is, right? How we found variance and standard deviation already yesterday. But this may look a little unfamiliar, but let me show you, let me stop this and go to a whiteboard, okay? I'm gonna open a whiteboard, right? Okay, and then so what is variance? You remember what we did in the last class, right? Variance of x. X is the random variable, right? But look, for our example, with our example, x was r, the return, monthly return. Remember that? I'll just call it x for now because our return is a random variable, and we just call random variable x. Okay. So, how did we find the variance? First, what we did was we found sum of squares, right? Remember what sum of squares? Sum of squared difference terms, right? And then we divided it by n minus 1. So what were the sum of squares? Sum of squares were literally sum of all the squared difference terms, right? Xi minus x bar squared, right? Remember this? What was this? This was the difference between each monthly return and the average return, right? Isn't it right? We did this and we squared it. We had like 60 of them, and then we summed everything, right? So number I ran from 1 through 60, right? And then we did n minus 1, right? Of course, if we write it in general notation, it would be I equals 1, meaning I runs from 1 through n. But in our example, n was 60, right? So we found variance this way. And then we took the square root of variance, right? To do what? We took the square root of variance to find the standard deviation of x, right? To find standard deviation of x. This is horrible. It's not handwriting, please don't. It is mouse writing. It's with the mouse that I'm doing this. So it's more like a drawing, and it's very difficult. So we know then all we need to do is we, simply xi minus x bar raised to squared, right, over n minus 1. So this is our formula for variance and standard deviation. But then, what you saw on the slide was a little bit different. Why? What you saw on the slide is with the probabilities. In other words, in our example, every monthly return data point had the same probability, right? Those were like, the probabilities were 1 over 60. They all had the same probability. So even if we use weighted average, it's still the same thing as the simple average, right? But if the probabilities are different, that's how you do it. You multiply everything by its own probability. And the notation in the slide is that case, just like the notation in the with the expected return. So if I go back to let me go back to the slide. Okay, now you see this, and So this is how you do the variance in the with the probability notation. Anyway, think about it. Probability is always, 1 over something, right? In our example, 1 over 60 is 1 over 60, right? If everything is 1 over 60, right? Then it will be just like the notation you saw on the whiteboard. And you remember this is the notation for standard deviation, right? Greek character sigma, standard deviation of random variable x. And remember, variance is the squared term of the standard deviation, so sigma squared. Makes sense? But when you use sometimes standard deviation, right? Variance, right? The notation. When do you use Greek character? When do you use non-Greek character notation? Remember the difference between the sample and population. Population is the entire data set. Sample is a local data set. So Greek character notation is reserved for population. Okay, and the otherwise, for sample, you use just non-Greek character notation. Another thing. So for our random variable is apple's return, right? So what is the population of Apple then? The population of, if you think about it, Apple, the entire data, so that means the entire data set for Apple. If you think about it, Apple started out in 1981. I mean, they went public and they got listed in NASDAQ and started being traded in the stock market in 1981. So if you use, if you go back to day one of, Apple 1981, right? Use the entire data set to calculate, mean and standard deviation. That's the population. But think about it. It's 40 years worth of data, 40 years, right? 480 data points, if you use monthly data, right? Monthly returns, 480 data points. Is it meaningful? I mean, is it useful? Or, for that, is it meaningful? No. Why? Think about it. Over 40 years, how much did Apple grow, do you think, Apple, in terms of return, of course, it's more than 10,000%, way more than 10,000%. And if you take average of such a wide range, you remember average is a neutral number. The mean of 400 data points, historical data. It's called also time series, right? The neutral number over 40 years is really, really useless. I mean, it tells nothing about what it's going to be next month. Understand? 40-year average tells very little about what's going to happen next month. It can tell something about what's going to happen in the next 20 years or next 40 years, but it cannot be a dependable guide for or inference point for the next month, right? So I've been telling you, if you want, anyway, the long run, the trend, right, deterministic trend will give you a meaningful inference point for long run, right? It cannot give you like last 5-year monthly return, right? Average of that cannot give you a meaningful guidance for tomorrow's return or next week's return, right? but at least they can give you a meaningful forecast for next month or the month after that, 2 months, into the future, 3 months into the future, right? And I told you, deterministic trend works in the long run, right? But what is the long run? Anything above 1 year is long run, right? Anything below 1 year is short run, right? So that means the reason we use 5-year data set, right? 5 years worth of data is to get a long run deterministic trend. But if the time horizon, if you're using like more than 10-year data set, right? 10-year, then it loses actual, it loses touch with the recent dynamics in the price, right? Think about it. If you use like 2 decades, data for 2 decades, right? Past 2 decades, right? Past 2 decades, price actions, right? Past 2 decades, price fluctuations, right? Has little relation with more recent, a couple of years price dynamics, right? So usually, the most common uh, data range for time series or historical data range for the stock market is the past 5 years. They don't even go back to past 10 years, 5 years, because that would be more relevant to the more recent price movements, right? Okay, so with that in mind, so how does that? We already know that we can nail. We can associate, certain. If you have a certain profit, right? Target return, you can associate that with the probability, right? So that helps us. Well, okay, that's good. But can it nail anything with, well, what I'm saying is it can nail something with the probability. The range of probability can be more narrower, more closer, right? The range of probabilities. So if you are like, what's the probability of getting 15 to 16%? For that 1% for that 1% return range, you can also nail it with probability. It's not a big deal. But then more than that, what's more important is, let's take a look at this example. Asset allocation. And so take a look. First, so since now you know how to calculate the expected return, so you researched hundreds of stocks. You're doing some stock picking. If you have $100,000 and you want to invest $100,000, you're not going to invest it blindly, right? You will do some research and you will pick some, possible, most likely possible winners, or most likely the likeliest candidates. So you researched, hundreds of stocks, and you selected, you came up with these 3 stocks. X, Y, and Z. And based on what? Based on their expected returns, right? 25%, 30%, 10%. Those are the expected returns, right? Now, so this, get the label. Expected return on I. That I represents individual stock. I means an individual asset. So for stock X, company X, the expected return would be expected return on X. This I will change right? This will be permutated with these labels, right? That's how you do. I is just a like a representative, blank uh, placeholder, right? So just like n, you are actually replacing n with specific time, right? So expect return on x, 25%, expect return on y, 30%, expect return on z, 10%. Now, so so obviously with $100,000, you would allocate most money into you're not going to allocate all uh, allocate you're not going to put $100,000 into just one stock, right? Because why? Uh, it's basically a common sense, right? Common wisdom. You don't put all your nest eggs into one basket, right? And obviously, between these three stocks, Y will be the most preferred because it's got the highest expected return, right? And then X will be the second, number two, second preferred. Z will be number three. But then think about it. So you might want to allocate the most of your funds into Y, and the second most into X, and the third into Z. But then the problem is you're only looking at expected return, but you didn't look at the standard deviation. But look at the standard deviation. Standard deviation of X is 40%. Standard deviation of Y is 60%. Standard deviation of Z is 15%. And what is standard deviation? Standard deviation is the fluctuation, average deviation from the mean, average bandwidth of the fluctuation from mean. And the fluctuation from the mean, deviation from the mean is what? That's the risk. Isn't that right? Risk is what did I say is the risk. Now, of course, in the bond, risk is, there's default risk, inflation risk, liquidity risk, maturity risk. Yeah. Yeah, of course, default means, you're not getting your money back. Of course, in stock, uh, uh, you don't call it default. I mean, because you didn't lend money to the company. You bought the stock uh, of the company, meaning you voluntarily, spontaneously, voluntarily became a part owner of the company. So even if you get zero or even that return as the owner, that's only your fault, right? You can't hold anybody else. You can't hold anybody else accountable for that but yourself, right? So it's not defaulting, but basically, risk is the probability of, including probability of loss, of course, losing all your money, right? Or uh, not only getting a negative return, right? Losing all your money is, getting a negative 100% return, right? Negative 100 return is losing all your money. That's the extreme bottoms, the extreme left side. I mean, you can't lose more than 100%. But to the right hand side, to the right tail, the potential gain can be more than 100%. It can be even 200%, 300%. There's no limit to the potential uh, gain, right? But anyway, so your risk is not only getting the negative return or getting 100% negative return or a loss, complete loss, but also I've been telling you, risk is defined as the probability of deviating, right, from the predicted return, right, expected return. So even if the return is higher than the actual return is higher than the expected return, it's still part of the risk because it's the variability around the mean. Okay, makes sense? So risk is not only a downside, there's upside risk too. I mean, upside risk is not necessarily a risk because nobody will be unhappy when there is when your actual return is greater than the expected return. I mean, nobody will say, "Oh, I got too much return," right? Nobody will say that. I mean, it's a pleasant surprise, isn't it? Right? It's a surprise. Risk is basically a surprise because that was something unexpected, right? What was expected was the mean, right? But either way, if it is greater than the mean or less than the mean, these are both are surprises, right? And then upside risk, it's called if you get higher than expected return, that's called upside risk. But if you get a higher return than expected, then this is a pleasant surprise, isn't that right? It's not something you would cry out or scream. You will scream with joy, if you get better expected return. But still, it's variation. In other words, it's the volatility, right? It's the volatility that's making it risky, right? And if you think about, of course, the meaning of volatility, to define it more correctly, volatility is not exactly the same thing as variance, right? But in the market, use the term volatility so frequently, as if it is the variance. No, volatility is only the part of the variance that is associated with the market's movement. But anyway, we're going to come back to that more about the definition of volatility later. But look, if you look at the variance of the return, right? So far, I mean, we call it upside downside, because it's better than if it is better than the higher than the expected return, it's up. Lower than the expected return, it's a bottom or lower. But then, if you flip it and turn it on the side, put it horizontally, there's left and right. Right? Remember, if you put it horizontally, I mean, if you put it vertically, if you set it up, flip it vertically, then this would be upper side, this would be lower side. But if you put it horizontally, this is right hand side, and this is the left hand side, right hand side, left hand side. So think about it. It's like driving a used car. If you buy a used car, what would be your biggest concern? The biggest concern is, is the brake? Biggest concern is the brake going to work when I, step on the brake? Is it going to stop the car when I want to stop the car? I mean, if the brake doesn't work, the worst, it's the worst kind of situation, right? You don't want that. Another thing is, are the wheels, it's a used car, so if you may end up buying a lemon, and then the wheels may be not well aligned, or wheels may wiggle, right? Especially if the front wheels wiggle, you got to do, the alignment is not, it's called alignment camber, or camber is the like the angle of the angle it makes with the the road surface, right? The surface. But I mean, alignment. If the alignment is wrong, or something is not holding the steering system right. If the steering system is faulty, then this is also a big problem, isn't it, right? I mean, if the car is not a lemon, right, when you keep your hand steady, right, it should stay on course, right? But if the steering system is faulty, then even if you keep your hand steady, the car may careen to the right or careen to the left. And this is a very dangerous situation. So it doesn't, think about it. Careening to the right is getting, a higher return than the expected mean. Careening to the left is, getting lowered. Either way, higher return or lower return than the expected return, still they are both risk, right? Hence, that's why it's called risk. And they specifically, usually, you're getting something above the mean. That's called upside risk. You're getting something below mean. It's called downside risk. And they would focus more on the downside risk than the upside risk. Now, but we spent a lot of time, but here. So let's think about it. If you consider the risk here, X as 40% risk, Y 60%, Z 15%. So this is pretty much, this goes pretty much, in concert, hand in hand with the old, conventional wisdom. Why? The conventional wisdom is what? The higher the risk, the higher return. The higher the return, right? The higher the risk, the higher the return. Lower the risk, the lower the return. Right? Makes sense? Then, if you consider the standard deviation, decision number one, stop, decision number two, decision number three, right? So they are in conflict. These two criteria, decision criteria, are in conflict with each other, right? This is a mind-boggling situation. I mean, if you can go with one criteria, go by only one criterion, it would be wonderful. But when you have to go by two criteria and they are in conflict with each other, then this is a mind-boggling situation, right? So what do? Well, then you will have to come up with some smart solution with that. And the smart solution is, return risk ratio or mean variance ratio. Return risk ratio or mean variance ratio. What is mean variance ratio? Mean variance is also called, return risk ratio. This is mean, right? Expected return is mean. Standard deviation is, you might say, oh, so should it be called mean standard deviation ratio? Yeah, you can call it mean standard deviation ratio as well. But you remember standard deviation and variance are like twins, right? They are like twins. So you can call it mean variance ratio as well. Now the idea is, why do you take this ratio? Isn't this, remember, when we did, a lot of things, a lot of things in the world uses benefit to cost ratio or output to input ratio. To measure what? To measure the productivity or efficiency, right? If the output is high for input, the efficiency is high. And everyone prefers higher efficiency than lower efficiency. Make sense? So think about it. And I've been telling you, think about it. Mean is the output. The expected return is the output. That's the benefit, right? And the risk is the input. Isn't it right? Risk is the cost in a way. I mean, to get this output, you must run this risk. To get this output, you must invest, pay this cost. Make sense? So then the higher this ratio, the better it is. Make sense? And I've been telling you all the time, as an example, typical example of mean variance ratio or return risk ratio or output to input ratio. What did I give you? Gas mileage. And I give you gas mileage, right? Gas mileage is a typical example of output to input ratio, and everybody likes. Gas mileage is also called, fuel economy, and everybody likes higher fuel economy than low fuel economy. This, isn't it right? Any rational person, and if you prefer lower gas mileage, you're not a rational person. Why would you want a gas guzzler, that runs, 0.1 mile for 10 gallons? By burning 10 gallons of gas, you just cover 1 mile or 0.1 mile. That is just, even a tank, M1 Abrams tank, will have a better gas mileage than, that. Right? Makes sense? But so the idea is, if you take the gas mileage on, simply like mileage on the stocks, right? The higher the number, and you do this has the highest, right? This is the highest, right? This is the second best. This is the third, right? Okay. So then what? You will allocate the most of your funds into the number one and second most into number two, third into number three stock, and your expected return on the portfolio consists of these three stocks, and your mean return on the portfolio will be the maximum. I wouldn't say it will be exactly the maximum, but it will be better than any other allocation, right? Of course, you can reach the maximum return by knowing exactly, by finding the exact optimal allocation weight, right? Optimal weights. By finding optimal weight, then you can reach the maximum portfolio return. But that is the top reserve for 300 in that analysis. And then interesting thing is, in the U.S., we use gas mileage. In the U.S., our gas mileage is miles per gallon, right? To calculate gas mileage, what do you do? If your car has 20 gallons, you fill 20 gallons, right? Run out of gas. And if you covered, 600 miles on a full tank of gas, right? 600 miles. I mean, that's a very crude way, but it's a very honest way. 600 miles divided by 20 gallons, so that's 30 miles per gallon, right? So miles per gallon is US. In a lot of countries, use inverse gas. What's an inverse gas mileage? Inverse gas mileage is like liter per kilometer, right? It's like in the U.S., gallon per mile. That's unthinkable in the U.S., but in most other countries, they use liters per kilometer. So if you use inverse gas mileage, right? It's not output to input ratio. It's the reciprocal, right? It's the input to output. So that means the lower the number, the better it is. Lower the number, the better it is. Think about it. To run 100 kilometers, so it's like, per 100 kilometers to 100 kilometers later would use, right? The lower the number, the better it is. And this is used by most countries, right? And then also for mean variance ratio, they have also the reciprocal of mean variance ratio. Look, this is a reciprocal, right? Reciprocal, right? Mean variance. Right? Raised to negative 1, that's the reciprocal, and that's coefficient of variation. Coefficient of variation. If we use coefficient of variation, the lower the number, the better it is. Still, you come to the same result. In terms of ranking, Z is your number 1 stock, X is your number 2 stock, Y is your number 3 stock. And then the weight allocation, I did it mechanically. This weight allocation, weight distribution was done mechanically. It doesn't have to be done exactly this way, but uh, you can use some arbitrary method. But see, the most weight is allocated into our number 1 stock. Second most weight is allocated into our Z. Third is allocated into Y, and sum of all these weights is 1, right? Of course, they cannot exceed 100%, right? All righty. So that's it for today. We'll discuss further about this in our next class. Okay, thanks for watching, and end of video.